we are expecting, as we've come through the fourth quarter here, there's been a fairly torrid pace of issuance going into the end of the year, and we do expect that to continue into next year. I think particularly if you look at the high yield market, where there's potentially up to 110 billion of callable debt that could be refinanced next year. And as you note, with the conditions as positive as they are right now, a lot of opportunistic refinancing should come in that market in particular in 2021. Also, as you note, there is a fairly good and building calendar of M&A on the leveraged finance side to fill the calendar for next year. And aside from that, there really still is the potential that some of the companies in our space that are more liquidity constrained will continue to need to access the markets, albeit in our most recent forecast for the year, we are calling for a fairly low default rate, which is one of the drivers of positive conditions in our market, but also hopefully an indicator that we won't see too many companies getting into trouble as we go through the year.
Oh, that's really fascinating, Ben. So let me pursue that last point, if I may, as well. The default rate is going to remain low, despite the fact that there are, and I can't open a newspaper at the moment without people talking about a more robust inflationary environment in 2021, reduction of some of that liquidity, which we've already just noted as well. The default rate is going to remain very low, despite the fact that the conditionality and the coupon demanded by many investors is going to be a bit higher in 2021.
Yeah, potentially. I don't disagree. I think the real prop that is under this market still, and one of the main drivers when companies in the leveraged finance space get into distress, is high interest rates. And if you look at where we are right now with 10-year bonds still broadly negative, 3-month LIBOR or Euribor, I should say, also negative, rates are very low. And I think you'd have to see a pretty substantial rally in underlying base rates in order to put stress on some of these companies from an interest payment point of view. And in addition, we've seen spreads contract, and we're at frankly fairly close to historical tights in terms of not only yield, but also in terms of spreads. So between the low and likely to stay low underlying base rates and these fairly tight spreads versus historical standards, it's hard to see companies coming under stress in our space due to the interest burden. So I really think it will be much more down to the fundamentals of businesses, how they deal with, now we're in lockdown again here in London, for example, and how these companies deal with the ongoing battle with COVID and how that affects their businesses. I think that will be more of a driver than what we're seeing in terms of any kind of rate movements, at least in the leveraged finance space.
Ben, let me ask you about the M&A activity we're seeing out there. There's been a ton of it. Lots of consolidations been happening, but some companies are also using their scrip after we've seen stock price rises. Why do you think there's a decent pipeline, though, for bond-financed acquisitions at this point?
Again, it's sort of anecdotal, and unfortunately, obviously, we can't discuss a lot of the projects that we're working on, but we've seen a pretty active pickup in the level of dialogue that's going on around potential M&A activity. And that really crosses, I know we're focused mostly on leveraged finance now, but certainly the large cap investment grade M&A pipeline is building nicely. There have been a few large recent announcements that people have seen in the press, and there is an additional calendar of potential acquisitions that are not yet announced. And that's the same in the leveraged finance space. So there are several announced deals that the market's aware of as we go into the new year, but there are also many more that are in the pipeline, not just here, but I'm sure at some of our competitors as well, building that calendar. And one of the things that's been very interesting, one of the trends that we've noted, at least here, is a number of potential public to private transactions. We just closed one that was announced and financed through the bond market last week, and there were no doubt more to follow. That's an attractive way for private equity firms in particular to get access to new companies by going through the sort of public to private takeover route.
You've been fairly upbeat in your comments across various different parts of the market, what you're seeing on the M&A side, central banks. But when it comes to risks around Brexit, you're a little bit more subdued in your tone. Just give us a sense of what could be coming if there's a no-deal arrangement with European partners. What impact does that have on high yield here in the UK?
Fair question, of course. And it's a little bit unpredictable. Clearly, the near term, as we wait to see what the final decision will be, the near term concern is that this could introduce a fair bit of volatility into the markets. at least particularly in the immediate post-Jan 1 period, as various businesses and the markets sort themselves out and figure out how to deal with whatever the new reality is. I think if you look in the broader context, a fair amount of the business that is generated in the European leveraged finance markets is European based. So while the UK is clearly a key financial center and will remain, we expect, a key financial center, a lot of the business that's generated by our clients actually comes to us out of the continental European market. So in terms of volumes and what that does to the level of new transaction supply, it's hard to see that being a big disruption. I think if anything, it's going to put more stress on the levels the prices that UK companies have to pay to raise money in our markets, at least certainly in that immediate period following Brexit. But overall, we're not expecting that as a firm, I think, to be highly disruptive to the leveraged finance market. If anything, I think it will be a fairly short-term disruption, and ultimately, as I mentioned, higher costs for some of the UK-based issuers. But overall, we think demand will continue to be there from investors, and this incredible amount of liquidity that is still out there underpinning our market as it has been all year will continue to support the market, even if there is some temporary volatility.